The lights are going out across Texas, and with them, a $1 trillion asset class is being repriced in real time. January 25th, 2026. And the ERCOT grid dashboard is flashing critical warning levels that energy analysts have seen since the catastrophic February 2021 freeze. But this isn't just another infrastructure failure story. What's happening right now in the Permian Basin and the data centers scattered across West Texas represents the collision of two massive capital flows that most investors don't even realize are connected. The forced shutdown of cryptocurrency mining operations due to grid curtailment is creating a cascade effect that repricing energy futures collapsing. Bitcoin hash rate and exposing a structural vulnerability in global energy markets that extends far beyond the borders of Texas. The current winter storm system is unprecedented in both its geographical scope and its timing relative to energy market positioning. Arctic air masses have pushed temperatures in Dallas to -8 degrees Fahrenheit and Houston to 14 degrees, and critically have created sustained below freezing conditions across the entire ERCOT footprint for what's now entering its fourth consecutive day. This isn't a short-duration cold snap that grids can manage through emergency reserves and demand response programs. This is a prolonged thermal stress event that's exposing every weakness in a grid system that was supposedly hardened after the 2021 disaster that left 246 people dead and caused $195 billion in economic damages. ERCOT's real-time demand is currently sitting at 78,400 megawatts, which would normally be manageable given the grid's theoretical capacity of 86,000 megawatts. But theoretical capacity and actual available generation are two completely different metrics when you read dealing with thermal power plants that KOE and operate efficiently in extreme cold. Natural gas facilities, which provide approximately 52% of ERCOT's generation capacity, are experiencing wellhead freeze-offs that are cutting production by an estimated 23%. Wind generation, which represents another 28% of the capacity mix, is operating at just 14% of nameplate capacity, because turbines are icing over and wind speeds are actually declining as the hypersurge system stabilizes. What this creates is a supply deficit of roughly 11,000 megawatts between what the grid needs to maintain reliability and what it can actually generate. That's not a small gap that you fill with emergency purchases from neighboring grids. ERCOT operates as an isolated grid precisely because Texas wanted to avoid federal regulation, which means there are minimal interconnections with the eastern or western grid systems. The DC tie capacity to import power from Mexico and the limited connections to SPP and CERC total maybe 1,200 megawatts of import capability. You cannot bridge an 11,000 megawatt deficit with 1,200 megawatts of imports. The immediate response from ERCOT operators is grid curtailment, which is the polite industry term for selectively shutting off power to specific users to prevent total grid collapse. The priority hierarchy is legally mandated. Hospitals and critical infrastructure stay online. Residential customers are protected as much as possible, and industrial users, particularly those with interruptible service contracts, get cut first. Cryptocurrency mining operations fall squarely into that interruptible category, and they're not just being asked to reduce consumption. They're being forced into complete shutdown across virtually every major mining facility in the ERCOT footprint. Texas has become the global epicenter of Bitcoin mining over the past 3 years, a deliberate consequence of the state's deregulated energy market and its abundance of cheap power, particularly during off-peak hours when wind generation floods the grid with excess supply. The migration of mining operations from China following the 2021 mining ban created a geographic concentration of hash rate that now represents approximately 38% of the entire Bitcoin network's computational power. RIOT Platforms operates a 700 megawatt facility in Rock. Marathon Digital has installations totaling 620 megawatts across multiple sites. Core Scientific and a dozen smaller operators combined represent another 1,100 megawatts of mining capacity. When you force the shutdown of 2,400 megawatts of mining operations simultaneously, you don't just reduce electricity demand. You remove 38% of the Bitcoin network's hash rate in a matter of hours. The Bitcoin blockchain adjusts mining difficulty every 2016 blocks, approximately every 2 weeks, based on how quickly the previous 2016 blocks were mined. But between difficulty adjustments, the hash rate is what determines how fast blocks are actually found. When you cut hash rate by 38%, block times immediately extend from the target of 10 minutes to approximately 16 minutes, slowing transaction processing across the entire network. The market impact shows up first in Bitcoin's price, which has declined 11% over the past 72 hours from $94,400 to $84,100. But That price move is just the surface manifestation of a much deeper structural issue. The crypto market is repricing the fundamental assumption that mining operations can access cheap, reliable power at scale. If Texas, which positioned itself as the mining capital of the world specifically because of its energy abundance, cannot keep mining operations online during winter weather events, then the entire thesis around energy arbitrage in cryptocurrency mining needs to be reconsidered. Energy arbitrage is the core economic model that makes Bitcoin mining profitable in competitive markets. Mining operators locate in jurisdictions where they can access electricity at 2.5 to 3.5 cents per kilowatt-hour during periods of grid surplus, then curtail operations when spot prices spike above their profitability threshold. This model works beautifully in normal market conditions, where spot price spikes are brief and predictable. But when you have mandatory curtailment, that's not driven by spot prices, but by physical grid limitations. The arbitrage model breaks completely. Miners aren't choosing to shut down because power got expensive. They're being forced offline because the power literally doesn't exist. The financial implications for publicly traded mining companies are severe and immediate. These companies have collectively invested over $8 billion in infrastructure build-out across Texas over the past 3 years. That capital was deployed based on utilization assumptions of 85 to 90% uptime, meaning the facilities would be mining Bitcoin roughly 90% of the time and curtailing only during the handful of days per year when it made economic sense to sell their power back to the grid at premium prices. But we're now 4 days into a forced shutdown with weather forecasts suggesting this cold snap persists through at least January 29th, potentially extending into early February. RIOT Platforms, which trades publicly under ticker RIOT, has seen its stock decline 18% this week to $8.42 per share. The company's market capitalization has contracted from $2.1 billion to $1.7 billion, a destruction of $400 million in shareholder value in less than a week. Marathon Digital, ticker MARA, is down 22% to $14.28, with its market cap falling from $3.8 billion to $3 billion. These aren't just sympathy moves tracking Bitcoin's price decline. The stocks are underperforming Bitcoin itself, which tells you that investors are specifically repricing the mining business model's viability, not just the underlying asset. The energy market implications extend far beyond cryptocurrency and into the fundamental pricing of natural gas, electricity futures, and the capital allocation decisions of power generation companies. Natural gas spot prices at the Waha Hub in West Texas, which typically trade at a discount to Henry Hub due to pipeline constraints, have spiked to $47.20 per million BTU, compared to $3.80 per million BTU just 2 weeks ago. That's a 1,142% increase in 2 weeks. And at S, being driven by the combination of supply constraints from wellhead freeze-offs and desperate demand from power generators trying to keep turbines spinning. What makes this price spike particularly significant is that it is occurring in a market that was supposed to have excess pipeline capacity after the completion of the Permian Highway Pipeline and the Gulf Coast Express Pipeline. Those pipelines were built specifically to alleviate the takeaway constraints that had historically kept Waha prices depressed. The fact that we re-seen $47 gas at Waha, despite that infrastructure, tells you that the supply destruction from freeze-offs is overwhelming the transportation capacity improvements. We're not dealing with a logistics problem. We're dealing with a production problem. The electricity spot market is even more extreme. Prices in the ERCOT North Zone hit the system-wide offer cap of $5,000 per megawatt-hour for 6 consecutive hours on January 24th, compared to typical prices of $25 to $45 per megawatt. When you're paying $5,000 per megawatt-hour for electricity, every single industrial process becomes steel production, chemical manufacturing, data centers, and obviously cryptocurrency mining all shut down because the input costs exceed any possible revenue generation. This creates a cascading demand destruction that paradoxically doesn't relieve grid stress because residential and commercial heating loads are completely inelastic. People cannot choose not to heat their homes when it's -8 degrees outside. The international dimension of this crisis is what should concern global investors most acutely. The storm system that crippling Texas originated in the Arctic and has created weather disruptions extending into Greenland, where temperatures have dropped to levels that are threatening critical infrastructure despite the region's experience with extreme cold. Greenland's Pacific Space Base, formerly Thule Air Base, has reported power system instabilities that required backup generation activation, and several remote settlements are operating on emergency power protocols. The geographic expansion of this weather system from Texas to Greenland isn't coincidental. It's the manifestation of polar vortex displacement driven by stratospheric warming events that are becoming more frequent and severe due to Arctic climate dynamics. What that means in practical terms is that the energy infrastructure stress we're seeing in Texas represents a preview of systemic energy deficits that will increasingly affect grid systems globally, not just in regions that are traditionally cold weather vulnerable. The cryptocurrency mining industry, which is concentrated in specific geographic regions based on energy cost optimization, is discovering that energy reliability is a more critical variable than energy price. The hashrate volatility we're re-experiencing creates second-order effects in crypto trading markets that most retail investors completely misunderstand. When Bitcoin hashrate drops by 38%, the immediate impact is slower block times and reduced transaction throughput. But the derivative effect is a surge in transaction fees as users compete for limited block space. The average Bitcoin transaction fee has spiked from $2.40 per transaction to $18.70 in just 48 hours. For context, during the 2021 bull market peak, transaction fees hit $62, but that was during a period of extreme speculative demand with normal hash rate levels. We're seeing $18 fees during a period of declining price action, which suggests genuine capacity constraints rather than speculative excess. These elevated transaction fees create a perverse incentive structure for the remaining miners who are still operational. The mining pools operating outside of Texas, primarily in Kazakhstan, Russia, Canada, and Scandinavia, are capturing not just their normal block rewards but also massively elevated fee revenues. A typical Bitcoin blocker rewards miners with 3.125 newly minted Bitcoin. This creates a profitability divergence that will accelerate the geographic redistribution of mining capacity away from Texas and toward regions with more reliable grid infrastructure, even if the base electricity costs are slightly higher. A mining operation in Norway paying 4.2 cents per kilowatt with 98% uptime generates better returns than a facility in Texas paying 2.8 cents per kilowatt. The capital markets are already pricing this realization, with private equity firms that were deploying capital into Texas mining facilities now pivoting towards Scandinavian and Canadian jurisdictions despite the higher operating costs. The global energy stock implications are nuanced and require sector-by-sector analysis. Integrated oil and gas majors like ExxonMobil and Chevron are benefiting from the natural gas price spike. But that benefit is entirely concentrated in their upstream production divisions. Their downstream and chemical operations are getting crushed by input cost inflation. ExxonMobil's stock is up 3.2% this week to $118.40. But that's underperformance relative to the commodity price moves, suggesting investors are concerned about margin compression in refining and petrochemicals offsetting upstream gains. Pure-play natural gas producers are the obvious beneficiaries of $47 Waha prices and $9.20 Henry Hub prices, up from $3.40 just 2 weeks ago. EQT Corporation, the largest natural gas producer in the United States, has seen its stock rally 14% to $38.70. Chesapeake Energy is up 11% to $92.80. Range Resources is up 9% to $34.20. But here, what is critical for anyone considering chasing these energy stocks. The forward curve does unsupport sustained high prices. Natural gas futures for March 2026 delivery are trading at $4.80 per million BTU, and by summer 2026, the curve flattens to $3.20. The market is pricing this as a short-duration weather event, not a structural shift in supply-demand dynamics. The electricity generation companies present a more complex risk-reward profile. NRG Energy, which operates significant generation capacity in would theoretically benefit from $5,000 per megawatt-hour spot prices, but the company's exposure is complicated by its retail electricity business, which serves residential customers at fixed rates. When you're rebuying power at $5,000 per megawatt-hour and selling it to residential customers at rates equivalent to $120 per megawatt-hour, you're incurring catastrophic losses on every unit of electricity sold. Energy's stock is actually down 6% this week to $87.30, despite sky-high power prices, specifically because investors understand that the retail exposure creates a liability that overwhelms the generation profit. Vistra Energy presents a cleaner exposure to ERCOT power prices because its retail business is smaller relative to its generation fleet. The company operates approximately 18,000 megawatts of generation capacity in ERCOT, predominantly natural gas and coal facilities that can actually run in cold weather, unlike renewables, with spot prices at $5,000 per megawatt hour and Vistra's marginal cost of generation probably around $200 per megawatt hour, including fuel and variable O&M. The company is printing money on every megawatt hour it can generate. This stock is up 8% this week to $134.20. And if this cold snap extends another week, you could see the shares push toward $145. As investors modeled the extraordinary profit margins, the renewable energy sector is experiencing a fundamental reassessment of its reliability value proposition. One of the core arguments for wind and solar expansion has been that these resources have zero marginal cost, making them economically superior to thermal generation once capital costs are amortized. But marginal cost advantages are irrelevant when the physics don't work. Wind turbines produce 0 megawatt hours when they're encased in ice, regardless of how cheap the technology has become. Solar panels produce minimal output when they're recovered in snow and when winter daylight hours are limited to begin with. NextEra Energy, the largest renewable energy operator in the United States, has seen its stock decline 4% this week to $73.80. The company's extensive wind portfolio in Texas is operating at 11% of nameplate capacity, contributing almost nothing to grid stability during the period of maximum stress. Investors are questioning whether the regulatory frameworks that compensate renewable energy purely based on energy production need to evolve toward capacity payments that recognize reliability. A megawatt of natural gas generation that runs 95% of the time provides more grid value than a megawatt of wind that runs 35% of the time on average and 11% of the time when you actually need it most. The cryptocurrency market structure is fragmenting along energy reliability lines in ways that will persist long after this particular weather event resolves. Ethereum, which transitioned to proof-of-stake consensus in September 2022, is completely unaffected by the Texas grid crisis because it doesn't rely on energy-intensive mining. Ethereum's price is down just 3% this week to $3,180, dramatically outperforming Bitcoin's 11% decline. That relative performance is creating a narrative shift within the crypto investment community around the sustainability and reliability of different consensus mechanisms. Bitcoin maximalists have historically argued that proof-of-work mining creates superior security through the physical expenditure of energy that makes attacks economically prohibitive. But when that energy dependency becomes a source of operational fragility rather than security strength, the argument weakens. If Bitcoin hashrate can swing by 38% based on regional weather events, what does that mean for transaction finality and network security during the actual attack scenarios that the energy expenditure is supposed to prevent? These are uncomfortable questions for a protocol that's supposed to be optimizing for decentralization and censorship. Resistance. The mining difficulty adjustment that is scheduled to occur approximately February 4th will be one of the largest downward adjustments in Bitcoin's history, potentially reducing difficulty by 25 to 30% to compensate for the sustained hash rate loss. That adjustment will make mining more profitable for the operations that remain online, but it also signals to the broader market that the network experienced a significant operational disruption. Every difficulty adjustment is recorded permanently on the blockchain, creating a visible scar that marks this event as one of the major hash rate shocks in Bitcoin's existence. The global energy policy implications are equally significant and will reverberate through climate negotiations and grid modernization discussions for years. Texas positioned itself as a laboratory for renewable energy integration, demonstrating that wind and solar could reach high penetration levels in competitive electricity markets. The ERCOT grid reached points in 2025 where renewables provided 73% of instantaneous generation. During periods of high wind and solar output, that achievement was celebrated as proof that the energy transition was not just feasible but economically optimal. But this winter storm is demonstrating the difference between instantaneous renewable penetration during favorable conditions and reliable renewable contribution during stress events. The grid needs to be sized and designed for the hardest hours of the year, not the easiest. When your renewable fleet contributes 73% during mild spring afternoons but contributes 9% during the coldest winter mornings, you haven't actually replaced thermal generation capacity. You've created a system that requires maintaining nearly full thermal backup while also financing the construction of renewable capacity, effectively paying for 2 complete generation fleets. The capital allocation implications of this dual fleet requirement are staggering and will reshape global energy investment flows over the next decade. If every megawatt of renewable capacity requires maintaining 0.85, megawatts of thermal backup capacity to ensure grid reliability during stress events, then the total capital cost of energy transition increases by roughly 60% compared to the simplified models that assume renewables can directly substitute for thermal generation on a one-to-one basis. That cost increase has to be borne by someone, either through higher electricity prices, increased government subsidies, or reduced returns on invested capital for power generation companies. The cryptocurrency mining industry is responding to this energy reliability crisis by completely rethinking its site selection criteria and operational frameworks. The era of chasing the absolute lowest electricity prices regardless of reliability characteristics is ending. Mining operators are now modeling portfolio approaches where they maintain geographically distributed facilities across multiple grid regions and regulatory jurisdictions, accepting slightly higher blended electricity costs in exchange for operational resilience that protects hash rate stability. Marathon Digital has already announced plans to develop 400 megawatts of mining capacity in Paraguay, which operates a hydroelectric-dominated grid that provides both low costs and exceptional reliability. The Itapu Dam generates surplus electricity that historically has been exported to Brazil and Argentina at heavily discounted rates. Marathon is negotiating power purchase agreements at 3.1 cents per kilowatt with baseload reliability, characteristics that Texas can no longer guarantee. The capital will flow to where energy is both cheap and reliable, and Texas is failing the reliability test. The broader macroeconomic implications connect energy market stress to cryptocurrency valuations through mechanisms that most investors do UNT track. When natural gas prices spike from $3.40 to $9.20, the cost increase flows through to every industrial process that uses natural gas as either a direct fuel source or a chemical feeds, fertilizer production, plastics, manufacturing, hydrogen production for refining operations. All of these industries are seeing input costs triple in a matter of weeks. That creates inflationary pressure that forces central banks to maintain higher interest rates for longer periods, which in turn reduces liquidity in risk asset markets, including the Federal Reserve's current policy stance assumes that inflation has been largely conquered, with core PCE running at 2.4% and showing a downward trajectory. But energy price shocks of this magnitude have historically created secondary inflation effects that persist for 6 to 9 months after the initial commodity spike. If natural gas prices remain elevated through February, you'll see that show up in March and April inflation prints. The global grid modernization requirements exposed by this crisis represent a multi-trillion-dollar infrastructure investment opportunity that will define energy sector returns for the next 2 decades. The Texas grid failure, combined with similar reliability events in California, the United Kingdom, and Germany over the past 3 years, is forcing a fundamental reassessment of how electrical grids need to be designed for a future where weather variability increases while energy demand continues growing through electrification of transportation and heating. The specific technologies that will attract capital are battery storage systems for grid stabilization, advanced natural gas turbines that can ramp quickly to complement renewable intermittency, high-voltage DC transmission lines that enable electricity transfer across larger geographic areas, and grid management software that can optimize dispatch in real time across thousands of distributed energy resources. Companies like Tesla Energy, which manufactures utility-scale battery systems, are positioned to benefit from this infrastructure build-out. Tesla's energy storage deployments grew 62% in 2025, and the business unit is approaching profitability as scale economics improve. NextEra Energy, despite its near-term stock weakness from renewable underperformance during the Texas freeze, remains the most aggressive deployer of battery storage in the United States, with 3,400 megawatts of storage capacity operational and another 5,100 megawatts under construction. That storage capacity provides grid operators with the flexibility to charge batteries during periods of renewable surplus and discharge during stress events, effectively time-shifting renewable generation to match demand patterns. The economics of battery storage have improved dramatically, with lithium-ion battery costs declining from $1.2 per kilowatt-hour in 2010 to approximately $140 per kilowatt-hour currently. The cryptocurrency mining industry's interaction with grid stability will evolve from being a problem that grids need to manage into being a solution that provides valuable demand flexibility. Mining operations are uniquely suited to serve as controllable load that can ramp up when the grid has surplus generation and ramp down instantly when supply tide ends. This demand response capability has genuine economic value to grid operators. And forward-thinking mining companies are beginning to structure their businesses around capturing that value through capacity payments and ancillary services contracts, RIOT Platforms has pioneered this model in Texas through its participation in ERCOT's demand response programs, where the company receives payments for providing interruptible load that can be curtailed within 10 minutes of notification. During 2025, RIOT earned $47 million in demand response payments, representing roughly 9% of the company's total revenue. But the current grid crisis is revealing that the compensation structure for demand response is inadequate. When you're being forced to shut down for 4 consecutive days, the capacity payments you received over the previous 12 months do UNT come close to compensating for the lost mining revenue. The forward-looking framework that aligns mining economics with grid reliability involves miners receiving substantially higher capacity payments in exchange for guaranteed curtailment during stress events, combined with ultra-low energy rates during periods of renewable surplus. This creates a symbiotic relationship where miners help absorb excess renewable generation that would otherwise be curtailed, while providing reliable load reduction during supply scarcity. Several mining operators are negotiating these structured agreements with power cooperatives and municipal utilities that have the regulatory flexibility to implement innovative rate designs that investor-owned utilities cannot easily match. The investment portfolio positioning that captures these converging trends requires exposure across multiple asset classes that most investors view as completely You need positions in natural gas producers to benefit from periodic supply tightness, positions in battery storage manufacturers to capture the grid modernization investment wave, positions in select cryptocurrency mining operators that are pivoting toward geographic and operational diversification, and critically, positions in grid infrastructure companies that own the transmission assets necessary to integrate renewable energy at scale. The specific names that offer asymmetric risk-reward are companies like Williams Companies, which operates natural gas pipelines that benefit from increased utilization as power generators burn more gas to compensate for renewable intermittency. Williams stock yields 4.8% and trades at just 12 times EBIT, despite owning irreplaceable pipeline infrastructure that will be essential regardless of how the energy transition unfolds. The company's Transco pipeline system moves 15% of all natural gas consumed in the United States, creating a strategic choke point that ensures pricing power. On the renewable side, the value is UNT in the pure-play wind and solar developers that are being exposed as unreliable during this crisis. It is in the integrated utilities that are using renewables as part of a diversified generation portfolio while maintaining sufficient thermal capacity for reliability. Duke Energy operates this balanced model with 49,000 megawatts of generation capacity split roughly 40% natural gas, 35% nuclear, 15% coal, and 10% renewables. That diversity enabled Duke to maintain reliable service through the winter storm while pure renewable operators struggled. The stock yields 4.2% and provides inflation-protected earnings growth through regulated rate-based expansion. The cryptocurrency exposure that makes sense in this environment is UNT through direct token holdings that experience 11% drawdowns in a week. It's through the infrastructure layer, specifically the mining operators that are successfully executing the pivot toward geographic diversification and the exchanges that facilitate trading regardless of price direction. Coinbase, which generates revenue from trading volume rather than cryptocurrency price appreciation, saw trading volumes surge 34% this week as the volatility created by the Hashrate decline drove increased speculative activity. The stock is up 7% to $218.40 and will continue benefiting from volatility regardless of Bitcoin's directional movement. The 5-day countdown we're experiencing isn't toward a government shutdown deadline. It is toward the moment when this winter storm breaks, and we can assess the permanent damage done to the Texas cryptocurrency energy nexus that shaped capital flows for the past 3 years. The operators who survived this crisis with their balance sheets intact and their strategic frameworks adapted to prioritize reliability over pure cost optimization will emerge as the dominant players in a restructured industry that looks fundamentally different than the one that existed on January 20th, 2026.